What is up, guys? Trey Campbell here, coming at you live. Really fast. Welcome to Friday. Friday is always a great day of the week, right? We're getting ready to kick off the weekend. Hope everybody had a good week trading in the markets. Just wanted to go over some stuff that I've come across in the next few minutes here. I'm not going to keep you long. I know it's Friday, but I just want to give you a little bit of information on some stuff that I have picked up and learned throughout the options learning that I'm now going through. So let me get things kicked off here, and let's get started. So again, my name is Trey Campbell. Welcome, and hope you can take something from this and learn, and let it blossom into something great for yourself. I think it will. I think you will learn that not everything has to cost a lot of money. We're going to go over a couple of things today. First being, we're going to go over how to trade options on a budget, because sometimes we want to get involved in certain stocks that cost a lot of money. If you want to buy 100 shares of, Apple, you got to be prepared to pay $14,000, right? Unless you're on a margin account. And even then, if you're going to hold it overnight, you still need half of that. So most brokers are only going to give you half margin overnight. So it's expensive. It's expensive. So I have come up with ways to help myself, especially because I have money all over the place, and I don't have just one huge account that I can trade stocks out of. So I have prepared for you a little presentation for today, and I hope you enjoy it. And let's get started. So what we're going to go over today, let me get the scene up here. Currently trying to get short in the ES market here. Let me move that out of the way and pull this up. So what I want you to understand and what you're going to get from today is I'm going to go over vertical spread, and it's long or short bias. So you can short it, you can go long with the vertical spread. This is huge because you limit your risk, and you can get risk down as low as $20. You can trade big names like Tesla, Apple, all those names that you want to trade that you don't have money for. To trade normally, to be able to buy the shares, or even to buy a naked call option, or whatever the different strategy is. And the downside is that it caps your upside. So really that's the only downside to this strategy. Okay, so let's go over the second one. Number 2 there is called the PMCC, or the poor man's covered call. It's a long bias strategy. So you're going to want to take it on a more long-term, long strategy, more of an investment strategy. It's a much cheaper way to simulate buying shares. It allows you to turn half of the wheel strategy. We got a video on the wheel strategy. If you need that, just go back a few videos here on our channel, and you'll see the wheel strategy. We went over that. That's a great strategy, but it does get expensive. So with this, we're able to turn half of the wheel without actually having to invest all the money. So we're going to go over all that. Upside is it keeps guaranteed money coming in. So that's the upside. The upside is, hey, you can that's guaranteed money coming in that you can depend on, that you can count on, like a paycheck almost, right? So that is the upside. The downside is you are on the hook. Just like if you were to buy the shares and you were to do covered calls, you got the price of the share, it could go to zero, correct? Well, in this case, your price of your option could go to zero and expire worthless. And if it does, then you're on the hook for the amount of money that you paid for the option. So, I've got a few examples. We're going to start with the vertical spread, and I'm going to go for I'm going to try to find us a long trade. Actually, Neil just gave me a great idea. He told me about a company, SPCE, and so we're gonna check it out, and we're gonna make a vertical spread for that ticker. Now I'm gonna show you how we limit our risk, and we get to trade a big name like SPCE, and how it caps your upside as well. So let's concentrate on the vertical spread right now, and let me see if I can get that pulled up for you. Actually, let me look right here really fast. Nope, didn't get filled. So let's bounce over here to the broker here, and I've already got it pulled up for you on the chart. So we like SPCE. It looks bullish. We think that it's going to keep pushing up, right? That's our bias, and we want to get involved, right? We want to get involved. Now, if we go to buy this stock right now, 100 shares is going to cost us $4,844. So, that's a lot of dough. And I told the title of this is on a Walmart budget. So how can we get involved with this cheaper? Well, it's simple. You want to trade options, and you want to trade the spread. So the vertical spread, right? And what we're going to do is we're going to choose either a 21 or 28 day. We're going to let's go 21 day. I think this thing pops in 21 days. We are currently trading at 48.21, which you can see the little green dot right here. So what we're going to want to do is we're going to try to find a option to call option, which is the option to buy 100 shares at our choosing. If we want the option, we can get the option. That's all we are trying to buy right now, is the option to buy. So you want to kind of go slightly out of the money. So let's go right here. Now this call by itself has cost us $840. So, and that's a 48 call. So what we do is, or $920, excuse me. Profit is unlimited, but let's look at that on just a table. So you are looking at literally having to get to, we did the 58.33 is the current price. You're looking at having to get to $58 before this thing starts showing signs of profit, right? So let's go back and let's see what we can do. So by applying the vertical spread, what you're going to do is you're going to find $1 difference between the two. And what this is going to allow you to do is to make that dollar in the middle if the stock goes up. Because what you're doing is you're going to be buying the option to buy, but you're going to be selling the obligation to sell. So what that means is at the end of your time, you would have to purchase you're going to have the collateral to sell the covered call. So essentially it is a kind of a covered call, because now you've got the buy option to cover that covered call, right? So it is a call that is covered by collateral. So let's just click right here and let's look at that. So that gives us $1, 48 to 49. So what we can do is we can look right here and we can see that if it goes to 48 to 49, we're gonna pay $40 for this with a max profit of 60. So right there, you've cut your risk. That's as much as you can lose on this. And then also check out this graph, how much it changes. So now we are literally in the profit at 48.33. We're $5 down. And then by the time we get to $49, we're at $60. And $60, we close the trade. Yeah. So theoretically, if you look at this, let's go back to, yeah, the chart. What we're looking for is $60. So we're looking for in the next 20 days for this thing to make a new high. And technically, we already said we don't need. Actually, all we need is 49 $49. $49. So if we can get to this point right here on the chart, in the next, few days, we are going to be in our max profit for that trade. That is a lot better than a naked call option. That's a lot better than buying 100 shares. You're basically taking the hold on, let me go back here. You're basically taking $40 and making 100 and so odd percent, because you're risking 40 and making 60. So 40 and 40 would be 100%. So you're making 150% right there. And no, that's not Joe Biden math. That's correct, I believe. So, that is, in theory, the spread, the vertical spread, call spread, and that is an option for you. Now, the further you go out of the money, the cheaper your risk is going to be. So if you feel like there's going to be a lot of volatility, you can bring this thing. Let's say you thought it was going to go to 60. Well, now you have a little bit more risk on the table. Have a little bit more risk here, $60, right? But look at your max profit at literally at $67. $70 there, around $70, you're maxing out at $440. Now that's a little, in 20 days, it could happen, but that's a little far-fetched for me. I like to keep it more, just a little tighter. So let's go back here and this thing keeps moving on me. Huh. So actually, let's go to the table. It'll be easier on the table. Yeah, look how far out we are. All right, so let's go up and let's go up. Okay, there we go. Now we're back. $35. Let's lock that so it won't move around on us. 35 to 65. All right, so basically you're making a lot of money right there, almost 200% on your risk on what you're actually investing. Because look, if I send this over right now, look at my debit. $37.30. That's the fees included. $37.30. That's it. That's what this trade costs. I cannot lose any more money. And the max potential profit is 65. So in the same order, basically what you could do, you can also do that on the sell side. So if you were expecting this thing to go down, you'd want to get out of the money on the put, and you could buy a put and sell a put. So you got the same thing, except for it's reversed, right? So anything you do, let's move it up just a little bit, maybe a little bit more here. Let's try to get it more evened out. So that risk profile looks like this. So as this thing comes down, see we're trading at 47.62 right now. At 40 at $44, we're going to be entering in our max profit for this trade. And the max profit for the trade is 40, whatever we said, 40 something dollars. So that's how you would do that on the reverse side. You would just want the uh, you know, to reverse everything. So I hope this is making sense. Let's go back over that right here so you can see that again. Vertical spread, long or short bias, it does not matter. I just showed you two examples where you could get long or short. Why is this an advantage? Well, it's an advantage if you're a broke trader, which you shouldn't be trading if you're broke, but you know, it is what it is. Some people are going to trade no matter what. This is so much smarter than just throwing your money into some kind of penny stock or something crazy. This allows you to actually trade name brand stocks, good stuff, you know, stuff that moves, stuff that you can really put some skin in the game on. Okay. All right. Anybody got any questions on that? Please let me know if you got questions on the vertical spread. It allows us to be trading this stuff on a budget. It allows us to trade it and still make good money. Yeah, we're capping our upside. That's the downside, right? But here's the thing. You're still making 100%. So how is that bad? Or 150% or 200% or whatever, you know, you're still doing good. All right, great, no questions. So let's go on to step 2. This is one of my favorites. I really like this, and I've grown to really love this strategy. This is a great strategy if you've got a little bit more money in that you want to get involved with. I won't say it's safer. Really, nothing's safer than that vertical spread because you're so capped on both sides. But with a poor man's cover call, you you get the feeling of buying the shares, and it allows you to turn half of the wheel strategy. Uh, the upside is guaranteed money. That's what's up. I want to give you a really cool example of this here in just a second. And you're on the hook, so get a good price. You know, get a good price. It's just like investing. So let's throw the chart up there. Actually, let me do one thing really fast here. Just check on my order. Make sure I haven't got filled yet. Still waiting there. All right. So let's look up Tesla. All right, good old Tesla. And then we'll give this example. I'll see if you got any questions. If you don't, then we will move on. Figuring tasty works out here, guys. So so far so good. So what you want to do with a poor man's cover call is you want to go way out. For first part, the first part is you want to go way out, because what you want to do is you want to lock in your shares, right? And you want to have those for a while. So what we're going to do is I'm going to go out to April, 77 days. And then what I'm going to do here is I will look to buy a call right here. Now, why am I looking to buy right here? Look at the cost of this. $15,000. All right. $15,000. $15,741. But keep in mind, Tesla is $819 a share. So if you wanted to buy 100 shares, how much would that cost you? $81,800, right? So I am purchasing a 720 call 77 days out at April 16th for $15,000, which is a huge, huge dip from buying the $818. So let's put that on, and then let's leave that on rather. And then what we're going to do is we're going to go up here to 7 days out, and we are going to sell a covered call on those. So we are going to sell, let's say, the 837. So what are we trading at? Yep, 837 right here. So we're gonna sell that, and look at what happened. Automatically got reduced by $2,000. That $2,000 just went in our pocket, and we're gonna collect $2,000 at least, somewhere in that range, a week every 7 days until we get exercise and have to sell those. Well, not really. Actually, you would sell it before it, finished out. But basically, you are collecting a premium, I should say, on that 15,000. So I just showed you one where it said 15,000 some odd, 607. Now you're at 13,607. So that's $2,000 that you just made against that position. Now, every 7 days, you are going to collect $2,000. Or, as this thing moves, let me throw this thing back down here. As this thing moves up or down, you can, kind of figure on where you want where do you want it. If it moves further down, you're obviously going to have to start taking these calls down in this area to sell. So it may go down, it may go up, but either way, it's a win-win, because here's the thing. It's just like simulating the cover call. If price closes above your 37.50, not only do you keep the premium, but you sell the 720 call that you bought up here. So it takes the place of that. You're selling the 720 at 837.50. Now, delta on this is a little low, so you have to be careful with that. It's about 70. So we'd have to do the math to try to figure out where this thing makes money, and this graph does not really give us that. So we know that we are here at 720. We've got the 77 expiration, and then we're collecting these covered calls. So now if I do that, you can see the difference. I'm going to need $900, 876, 880 for this thing to break even. And currently we are trading at 820. So we need to get back up here to 880 before it breaks even. But regardless of that, we're collecting premium on that while it's doing that. And now that we have that information, we can go back here and say, okay, we need to add 720 to 8 So, this thing doesn't do a really great job about analyzing like a poor man's cover call or anything like that. And I don't know how you add more strategies to this, but I have seen more strategies added in. So if you can figure that one out, that would be really cool. But anyway, that is the setup for that. So you are collecting premium, which is a weekly paycheck of $2,000 on your $13,000 position or your $15,000 position, and you're collecting those $2,000 a week until that $15,000 position is worth 16,000 or 15,000 or wherever it is that you want to sell that position. You get out of it, but you're using that position as collateral to collect premium on the option call side, on the covered calls. So basically it's a covered call strategy, it's a premium strategy, and it's guaranteed money. It's guaranteed. You, as soon as you hit go, it puts the money in your bank, and then 7 days later you can do the same thing. 7 days later you do the same thing. 7 days later you do the same thing. Another good example is SPY. If you trade the SPY, just remember SPY has 3-day expirations, right? So let's say we went out, let's go May, and then let's see what we can get here. What happens if we buy that? Delta's pretty low, 60 on that one. Well, we're going to go with it. And then you're going to take a 3-day. And then looky here. Look what 3 days is giving you. So we could come right down here and sell that. Review and send. So you're going to pay $1,200 for that. But so look, take that off. $2,600 you're going to pay for that, but because you're getting to sell those legs, to sell the premium, you're collecting for your 3 days, you're collecting forget where I was at. That's not where I was at. Either way, anyway, you're collecting for $2,500. You get to collect your $130, and then hopefully, if it gains value, this 363 will gain value, and you will be able to sell these in a profit, and also keep your $133. Again, you can't see that because it's all messed up, but it is a really good strategy, and it does work if you just want to collect premium, or use it to collect enough money just week by week to get by. And another thing you can do too is you can, if the market starts moving against you, you can kind of layer into these positions, and you can start collecting premium on a bunch of on different sides. So let me give you an example. So let's say we started let's say we're bidding these up, right? All 3 layers. So what you would do is then you would turn around and you would say, okay, those 3, let's delete that leg. These 3 positions are going to cost me $7,800. Well, then you can come up here to your 3-day, and you can say, okay, I want to sell. I want to sell this one. And then what we're going to do is we're going to come down here. we're going to change that to 3. And sorry guys, I'm still learning this strategy or this platform. I'm trying to oh well. Either way, I was just trying to give you an idea of what it would look like, but you can kind of layer into it as well, and then that way, as this thing started coming back up, you were collecting premium, and then the way and the money strike that you bought way down here is gaining value because this is moving further away from it. So we paid $26 for it down here. As this moves up, it should be worth $30 or whatever as it moves up. So and then on top of that, we're also collecting the premium. Just a food for thought there. Just to give you guys a rundown of everything about to get filled here. Those are the 2 strategies I wanted to share with you guys, because here's the thing. If you can trade on a budget, you can make plenty of money. There's plenty of money to be made. You don't have to be a huge player. My favorite right now is the vertical spread, just because it allows you to, it's just real flexible. The poor man's cover call is more mid-range players. They don't have enough money to be buying a full 100 shares, but they've got enough money to still play the game. And the cover call, the poor man's cover call, is a great strategy for just for people who want residual income. That's vertical spread is great, but it's a full-time job, because it's just like sitting and trading stocks. You got to be looking all the time. Poor man's cover call is you can get into your favorite stocks and just milk them. And it costs a little bit more money to do that, but it's worth it. So those are the 2 that I've got. And if you got any questions on either of those, please let me know, and I will be more than happy to help you in any way that I can. It's pretty self-explanatory. It's not huge, and I'm sure most of you probably heard of these strategies, but at the end of the day, they do have a lot of power behind them to help us as smaller traders to be able to play this game, and to actually play it with really good odds. So that's all I got. And if anybody's got any questions, you know where I'm at. You can hit us up at any time. And until next time, I hope you guys enjoyed the video. If you did, like it, subscribe to us. And we also live streamed this morning. We had a live trade. I'll show you that really fast. And then I'm going. So this morning we opened up and bought this dip right here and sold it back out. And then, I'm trying to get short again right here. Oh, this was a buy. Now I'm trying to get short on the futures market. So the bot's still in limbo just because it's, volatility is too high. So we'll see. We'll see what happens to that. So thank you guys for watching, and I appreciate it. I truly do. And I'm always here if you guys need any help. So let me know, and I will talk to you guys later. Thank you. I appreciate it.